Florida's once unshakable real estate market faces a dramatic and terrifying shakeup. Cities that were thriving hubs of prosperity now confront sharp, undeniable price declines. Surging, unwanted inventory chokes the market, and buyers mysteriously vanish from open houses. Across the Sunshine State, median home values have plummeted by tens of thousands of dollars, with some communities enduring drops exceeding 15%. A brutal one-two punch of relentlessly rising mortgage rates and skyrocketing insurance costs is utterly hammering affordability for countless families. Homes that once sparked bidding wars and vanished in days now languish for months, forcing desperate sellers to slash prices and offer massive incentives. Investors are in full retreat, their confidence shattered. Rental markets are visibly softening and aggressive. New construction tragically floods already weakened neighborhoods. These aren't just any cities. These are the 10 fastest collapsing housing markets in Florida, where the dream of paradise is slipping away faster than ever before. Number 10, Homestead. Situated in the southernmost reaches of Miami-Dade County, Homestead rapidly grew as a perceived affordable entry point to the sprawling South Florida market, attracting families and service members. Its housing market soared, reflecting immense desirability for those priced out of Miami's core. But now, Homestead's expanded housing market flashes critical warning signs. If economic conditions worsen, it could face a severe 2008-style collapse, with home values potentially dropping by 15% to 20%. Homestead's explosive growth was driven by its relative affordability, its military presence, specifically Homestead Air Reserve Base, and its robust agricultural industries. This led to substantial price appreciation, with median home prices peaking around $420,000 in 2022. However, this growth has collided with a brutal reality. Annual insurance premiums for homeowners here can easily soar into the $7,000 to $10,000 plus range, even for modest homes, transforming what was once affordable into an unbearable burden. With current 7% mortgage rates, a $350,000 home now costs over $2,300 per month in principal and interest alone. Inventory has already surged up 30% year over year, and homes are sitting longer, averaging 80 days. In a true meltdown scenario, this surplus combined with the crushing insurance burden would overwhelm reduced demand, leading to widespread price reductions and a painful erosion of equity, reminiscent of the widespread financial devastation seen in 2008. Number 9, Fort Lauderdale. This city, celebrated as the Venice of America, with its stunning beaches, intricate canals, and world-class yachting industry, grew at an incredible pace. It epitomized the luxury coastal boom that significantly contributed to Florida's broader housing bubble. Its rapid price explosion, fueled by high net worth migration and investment, was an early warning sign of truly unsustainable growth. Fort Lauderdale's boom was overwhelmingly driven by wealthy out-of-state buyers, foreign investors, and remote workers chasing an aspirational lifestyle and perceived exclusive value. Home prices exploded to a median of $680,000 in 2022, utterly detaching from local incomes and fundamental value. This created a strong pull for developers to rapidly expand, pushing ever higher with luxury condos and beachfront properties. Now the engine is stalling. Buyer demand from even affluent, out-of-state and international sources has significantly cooled. Inventory, particularly in the luxury condo and waterfront segments, is spiking. Prices are sliding back down to an estimated $5,555,000, a $125,000 drop, or nearly 18.4% from its peak. This coastal paradise was simply never meant to sustain such inflated valuations, and its financial foundation is cracking, a direct result of the bubble's expansion. Skyrocketing coastal insurance costs driven by increasing hurricane risks now often top $10,000 to $15,000 annually, adding immense pain for homeowners. Fort Lauderdale's rapid speculation-driven growth was a clear symptom of the bubble's beginning, and it's now experiencing a hard reset that's hitting hard at the high end, making it a critical market to watch for further declines. Number 8, Naples. Naples has long been known as one of Florida's most upscale real estate markets, a gleaming pinnacle where beachfront condos command millions. But in 2025, even luxury isn't immune to the chilling descent. At the peak of the pandemic, the median home price in the Naples metro soared to $675,000. By mid-2025, prices have corrected to around $595,000. That's a sharp $80,000 drop, or nearly 12%. High-end homes that once commanded $2 million are now selling for $1.7 million, or lower as demand pulls back. Inventory has swelled dramatically more than doubling to over 6,200 active listings. Luxury properties over $1 million are languishing for 100-plus days, with sellers aggressively cutting prices or offering desperate buyer incentives. One of the most devastating issues is cost. Homeowners insurance in Naples now averages more than $8,000 annually due to rising hurricane risk. Property taxes are hitting non-residents and investors hard, averaging over $11,000 annually for a $1.5 million property. Combined with a 7% mortgage rate, a $600,000 home now costs over $4,200 per month in principal and interest alone. If you're finding this crucial analysis of America's collapsing markets indispensable for your future, please gently hit that subscribe button to discover the nation. Your support powers our vital investigations. The rental market isn't faring much better. Average rents have declined from $3,200 in 2023 to around $2,800 in 2025 as competition intensifies. Naples remains stunning, but its market correction is sending shockwaves across Florida's high-end real estate scene, grimly signaling that even premium zip codes are tragically not recession-proof. Number 7. Jacksonville. The largest city by land area in the continental U.S. saw massive housing gains between 2020 and 2022. But in 2025, the story has shifted from relentless boom to a chilling, undeniable slowdown. The median home price in Jacksonville has dropped from its mid-2022 high of $410,000 to around $357,000, representing a brutal fall of $53,000, or nearly 13%. What's causing this sharp downturn? It's a devastating mix of higher borrowing costs, pervasive overbuilding, and a dramatic rise in housing inventory. Active listings have horrifyingly approached 9,000, over a 100% increase since 2021. Homes that used to vanish within 10 days now painfully linger for 40 to 60 days, and many desperate sellers are cutting prices or offering cash to attract any buyers. This overwhelming oversupply is mercilessly putting downward pressure on prices. Property taxes have climbed to around $3,800, and insurance premiums average $4,200 annually, hammering affordability. A $357,000 home now commands over $2,500 per month for principal and interest alone. A monumental leap for a city where median household income is $63,000. Rents have also declined, mercilessly squeezing landlord margins. Jacksonville's housing market is clearly in painful correction mode. Rising inventory, crushing affordability pressures, and relentlessly costly overhead are tragically reshaping what was once a pandemic-era housing winner into a dire cautionary tale. Number 6. Aventura. This gleaming, affluent city in Miami-Dade County, renowned for its towering luxury condominiums, world-class retail, and appeal to high-net-worth individuals and international buyers, was a symbol of South Florida's immense real estate expansion. But in 2025, Aventura is now confronting a full-blown market correction, particularly in its once booming high-rise condo sector, threatening a significant collapse. Median condo prices in Aventura peaked near $580,000 in 2022, fueled by sun-seeking investors and international capital. By mid-2025, that number has visibly dropped to around $490,000, a $90,000 decline, or roughly 15.5%. This substantial price correction signals deep trouble. New state-mandated condo reserve funding rules, courageously passed in the wake of the Surfside collapse, are mercilessly shaking up associations. Condo fees in older luxury buildings have surged, terrifyingly doubling from $700 a month in 2021 to $1,500 or more in 2025. Some owners now face massive special assessments of tens of thousands of dollars. These relentlessly rising costs, coupled with stubborn 7% interest rates, have utterly decimated affordability for even wealthy buyers. A $490,000 condo, with today's rates and $1,500 HOA fees, can equal a monthly housing cost exceeding $4,500. Insurance is another unfolding disaster. In 2020, insurance on a typical 1-200 SKU FT unit ran about $2,500 annually. Now it's horrifyingly over $5,000, in many cases especially for older concrete high-rises near the coast. Add in relentlessly rising sea level concerns, stricter inspections, and a slowdown in international capital, and it's brutally clear why buyers are backing off. Inventory is also surging. Condo listings in Aventura have risen dramatically, an unprecedented glut. Sellers are cutting prices fast, sometimes offering $20,000 cash incentives or waiving closing costs entirely. Rental prices are softening too. What was once a vibrant, high-yielding market is now seeing the cracks widen, weighed down by crippling fees, declining demand, and systemic risks that continue to mount. Number 5. Tallahassee. As Florida's state capital and home to major universities like FSU and Florida A&M, this city often felt like a more stable anchor in the state's volatile housing market. But in 2025, Tallahassee is suddenly waking up to a sobering, inescapable housing reality as its unique economic base faces pressures that threaten a significant market collapse. Tallahassee's median home price soared from around $290,000 in 2020 to a peak of $350,000 in 2022, a notable 20% increase for a capital city. But in 2025, that stability is grimly deflating. Median prices have dropped to approximately $290,000, representing a brutal $60,000 dip, or nearly 17.1% from the peak. This decline exposes the vulnerability of a market where prices outpace the steady but not explosive growth of its core government and education sector wages. Part of Tallahassee's problem is an accumulating inventory. While not on the scale of speculative coastal areas, new construction increased, and homes are now taking longer to sell, averaging 70 to 80 days on market. Property taxes now average over $4,000 per year, and insurance premiums, especially in hurricane-prone zones, have climbed past $4,500 annually, adding immense financial strain to homeowners, even for more modest homes. Mortgage rates around 7% have brutally hammered affordability for local government and university employees. Orlando's rental market is also conspicuously losing steam, with rents declining and investor landlords struggling. Household incomes average $60,000, yet basic mortgage payments now consume over 45% of take-home pay. For now, Tallahassee's charm remains. But for homeowners and landlords, its real estate market is revealing some very real and painful cracks beneath its traditionally stable facade. Number 4. Panama City. This major city in Florida's Panhandle, known for its deep-water port military presence and its massive rebuilding efforts after Hurricane Michael saw a significant housing boom. But in 2025, that aggressive growth and post-disaster recovery have ironically set the stage for a painful market collapse, threatening its hard-won progress. After experiencing immense damage from Hurricane Michael in 2018, Panama City saw a massive influx of rebuilding funds and new construction, pushing its median home prices up significantly. The median home price has now dropped to about $285,000, representing a decline of over $45,000 or 13.6%. While that may not seem extreme compared to big city drops, it's brutal for a market still recovering. What's driving this devastating collapse? Insurance is at the absolute top of the list. In 2020, before the recent surges, the average premium was just over $2,500. Today, it's more than doubled to over $5,500 annually. In flood-prone areas, that number can horrifyingly climb above $8,000. These crippling costs are making homeownership unaffordable for many driving-away buyers. New home inventory has surged by over 40% as rebuilding completed, but these homes are sitting conspicuously empty. Days on market jumped to 90 plus. Builders who ramped up post-storm construction are now facing the worst of it. Contract cancellations have surged, and spec homes are languishing. Property taxes have also risen as assessments catch up. For many, it's simply unsustainable. Panama City is still resilient, but its market built on a foundation of costly recovery and aggressive supply is brutally shaken, and 2025 may be just the beginning of its painful descent. Number 3, Sarasota. Known for its white sand beaches, vibrant art scene, and a sophisticated retiree population, Sarasota became a prime magnet for high-end investment and second home purchases. Its rapid price appreciation and overvaluation fueled by affluent buyers marked it as a key flashpoint, where Florida's housing bubble truly began to inflate in the luxury segment. Sarasota's market overheated rapidly, driven by out-of-state wealth seeking paradise and speculative gains. It was labeled one of the most overvalued metros in Florida, peaking at 38% over fair market value in 2022. This aggressive upward trajectory, detached from local economic fundamentals, was a clear symptom of the bubble's formation. Now in 2025, the balloon has devastatingly popped. Inventory has soared to levels not seen since 2015, with over 3,700 homes listed for sale, putting serious pressure on prices. Homes that were once fetching $1.2 million are now struggling to move at $975,000, representing a colossal 18.75% drop and signaling widespread financial distress. If you're finding this crucial information for understanding current market trends, please gently hit that subscribe button to discover the nation. Your support helps us bring you more vital insights like this. Buyers are tightening wallets, and mortgage rates, topping 6.75%, mean the luxury home crowd is getting pickier or disappearing. Add in crippling insurance premiums, $8,000 to $10,000 plus annually for waterfront homes, and the true cost of ownership is unbearable. Sarasota's market, once riding high on speculative luxury, is now in painful correction. Its overvaluation serves as a stark reminder of where the bubble truly took hold. This market's current state highlights the extreme vulnerability of high-end amenity-driven areas to rising costs and shifts in global wealth, making it one of Florida's fastest collapsing markets. Number 2, Miami. This glittering, iconic global city, a magnet for luxury tourism, international investment, and vibrant culture, experienced an unparalleled housing boom. Its radiant sunshine seemed to promise immunity from economic woes. But in 2025, Miami's housing market is confronting a devastating collapse, with values plummeting as its core drivers falter. Miami's explosive growth was fueled by its booming tourism and hospitality sectors, a continuous influx of international capital seeking safe haven and an appealing lifestyle. This pushed median home prices across the Tri-County region to a peak near $540,000 in 2022, while median condo prices soared to $423,000. However, a severe market correction is now underway. Property values across the Tri-County have dropped to around $450,000, a 16.7% decline. But the damage is far more brutal in the condo market, where prices have plummeted to $320,000, a devastating 23.8% loss. The danger for Miami is compounded by Florida's escalating and crippling property insurance crisis, which already adds thousands to homeownership costs. In a deep market downturn, this burden becomes unbearable, triggering defaults. The sheer volume of new luxury inventory built during the boom would sit empty as demand for high-end second homes or investment properties plummets. Mortgage rates at 7% would make luxury purchases untenable for most buyers. Inventory is surging dramatically, with condo listings in Miami alone rising from $9,000 in 2022 to nearly $17,000 by mid-2025. An unprecedented glut. Rental prices are softening too. What was once one of the strongest housing markets is now seeing the cracks widen, weighed down by crippling fees, declining demand, and systemic risks that continue to mount. Miami is still dazzling, still dynamic, but the real estate math no longer adds up. For anyone hoping to buy in 2025, Miami is a city of dreams built on shaky ground. And beneath the skyline, the crash is already happening. Number 1, Bal Harbour. This ultra-exclusive, opulent village, a pinnacle of luxury in Miami-Dade County, is renowned for its towering multi-million-dollar condominiums, world-class designer boutiques, and its global allure to the ultra-wealthy. But in 2025, Bal Harbour stands as the absolute ground zero, where Florida's housing bubble truly exploded in the luxury sector. Its unchecked expansion and speculative fever are now transforming into a profound and catastrophic collapse. Bal Harbour's housing boom was fueled by an intoxicating mix of unprecedented international investment, the influx of crypto millionaires, and pervasive speculative flipping in its high-end towers. This pushed median condo and home prices to astronomical heights, often peaking between $2.5 million and $3.5 million by mid-2022. This aggressive, high-stakes expansion was a definitive symptom of the bubble's early and extreme inflation. Now, the terrifying reality behind the glamour is a market in free fall. Prices are down 20% to 25% from peak in many key ultra-luxury buildings, translating to an astonishing $500,000 to $700,000 plus loss per unit. The global investor class has vanished. Foreign buyers are pulling out amidst capital controls and global economic uncertainty. The devastating result, thousands of multi-million-dollar units sitting unsold or worse, catastrophically underwater. Insurance premiums have exploded, especially for older concrete high-rises near the coast. Driven by new safety regulations and hurricane risk, many owners face crippling annual premiums exceeding $15,000, $20,000, or even $30,000 plus, on top of massive special assessments for building repairs. Bal Harbour is still dazzling, still exclusive, but its real estate math no longer adds up. For anyone hoping to buy in 2025, Bal Harbour is a city of dreams built on fatally shaky ground. And beneath the skyline, the crash is already happening, starting at the very top. Final thoughts. The message is clear. Florida's real estate landscape is shifting dramatically. Stay informed. Stay vigilant. Its beaches still call. Its skies are still blue. But beneath the sunshine, the cracks are showing, especially in the housing market. From Lakeland to Cape Coral, from once booming suburbs to fast-growing cities, buyers are waking up to a new reality. The same homes that soared in price just 2 years ago are now sinking. This isn't just a slowdown, it's a reckoning. Overbuilding, inflated pricing, sky-high insurance, and shaky rental returns have left many Floridians and hopeful newcomers holding the bag. In some cities, that bag is full of falling equity and rising regret. The American dream didn't disappear here, but it did get distorted. So if you're looking to buy in Florida, be cautious, be informed, be strategic. Not every palm tree hides a paradise. Some are planted in markets that won't recover for years. Don't forget to like this video, share it with anyone who needs to see this vital information. And of course, hit that subscribe button for more in-depth analyses from Discover the Nation. We'll see you in the next video, because sometimes knowing where not to buy can be the best investment decision of all.